Good day, everyone. Thanks for joining us for another My Wealth video series. Today it's a good one and a very well-timed one, just given the market activity that we've been seeing. We have Kevin Vandermeer. Kevin is our managing director and a portfolio manager with Canaccord Genuity, and also Meng Gao, who's a senior associate with Kevin and his team, and a very instrumental part of it. Today's call is going to be recorded, so check your emails in the coming days for replay information. And if you have any question, there's a comment box on the bottom. Just type it in, and we'll try and ask you or ask your question if the time permits. You can check on our YouTube page afterwards as well for that, or Facebook page at facebook.com/mywealthmanager.ca. Also on the line is on our team are Dave Townshend and Raheem Somani. We're both senior investment advisors and have been with us for more than a decade. And with that, we'll pass it over to Kevin Vandermeer. Kevin, thanks for joining us, and glad to have you on.
Great. Well, it's good to be back, and thank you everybody for joining the call. So this afternoon we're going to kind of give you an update on global markets and sort of what has been going on. Obviously, one of the most volatile weeks we've seen in a very long time, maybe is going back as far as 2008. But yeah, we'll give you a kind of an overview of global markets, as well as some of the asset classes and some of the commodities. So if we flip to the first page. And what we're looking at here is a graph of global equities. What we're wanted you to pick up on is that US and Canada have been among some of the strongest over the last year, as well as what's called EFI, or Europe, Africa, and Far Asia. And then some of the markets that have been struggling the most have been emerging markets in China. So I always like to start with the perspective of understanding kind of where markets have been and what has been performing well. At different times, you would have seen China as being one of the top performing markets. And if you remember going back, China was the first to have COVID, and was actually the first to come out of COVID, and those international markets in China in particular was one of the strongest during COVID, which is sort of counterintuitive in many people's thinking. Go to the next slide. Here's where we thought we'd just look at, give you an idea of what's been performing well inside the US. So looking specifically at different sectors. What you'll see is energy has been really strong, in part because of the commodity having been strong. And you'll remember in the middle of COVID, oil actually went negative briefly. Technology has been a strong sector, but more recently has sold off, and we'll show you some of that data. But you can see energy strong, part of what's called the reopening trade, if you will. Real estate doing better, but has pulled back a little bit from as a result of some of the concerns around rising rates and inflation. But on the whole, you can see that the economy is doing pretty well, and really it's kind of these hard asset sectors that have been performing better, if you will, more recently. Go to the next slide. And in many cases, it's the same story here in Canada. Again, energy very strong, with the commodity being strong. Another area is financials, and financials do better in a rising rate environment. I won't maybe spend a lot of time on that, other than to say that banks and other financial institutions like insurance companies do benefit from rising rates. So energy and financials, not surprising, done well. The area that has lagged the most is healthcare. In Canada, we have a very small healthcare sector, and it's predominantly dominated by cannabis. And some of the regulatory environment has been somewhat challenged for those businesses. But you can see, on the whole, many of the sectors in Canada have performed well. And one of the reasons why the Canadian economy or Canadian Stock Exchange is up so much is because energy and financials are the two largest sectors within the index. So when those two sectors do well, not surprising that the overall index is up. Next, look at commodities in general. I think it's good to just kind of understand how commodities are doing. You see that natural gas and oil, or WTI, both up strong over the last year. And if we were to put copper would be up as well. And then more sort of safe haven materials like gold is considered sort of a store of value and something that's bought usually in a crisis. They haven't performed as well. So that understanding what the commodity has done can also help you understand why certain sectors are doing well. So we just showed you that energy is doing well, obviously off the back of stronger commodity prices, and specifically oil. Next, we'll look at fixed income. Many of you would have a portion or a larger portion of your investments in fixed income. And what we're looking at here is just how they have performed. Not surprising that government bonds and more corporate, higher quality bonds have performed poorly because of rates going up. And when rates go up, bondholders demanding a higher return in the face of higher inflation, what happens is that hurts bond prices. So if you're an existing shareholder or owner of a fixed income product in a rising rate environment, can be challenging. Where what has performed well has been high yield, and high yield would perform more like equities. So it has a higher risk profile, but in this environment has performed better than some of the more conservative bonds. And then the next couple of slides, I'm just going to walk you through some of the other things that have been going on. I think all of us are exposed to lots of different types of media, and I think no presentation is complete without commenting on Bitcoin or some of the more concept type stocks, or in terms of kind of the non-profitable stocks. And so what we've tried to do here is just show you that in many of the portfolios that we invest in, we would look for high quality companies that generate real cash, real earnings. And what you can see is that while many of these concept stocks, and I'm thinking of companies that don't generate real cash and real earnings, really got expensive, on the back of COVID and into the early part of last year, but have really pulled back in a quite a dramatic way. And part of that is being felt inside the NASDAQ. The NASDAQ is now down, probably more than 10%. And what this chart just shows is that, when things go up a lot and they aren't supported by real cash and real earnings, they can come in quite violently as well. So sometimes it's better with the more conservative capital to stick with obviously the higher quality companies. Go to the next question. Next slide, shall we say? Here's a chart that was produced by our analyst, our technical analyst, and I think it's really good to kind of help us think about where we think the market might go in the next year. What this shows is it's basically laying over what's called the 4-year cycle. So you're looking at for many 4-year cycles since 1949, and it really is what's called a good analog, kind of a roadmap, if you will, for what might happen. And it has proved in this market to be, a fairly good compass, if you will, for when things get overextended or underextended. So you look at the middle of, kind of in the middle of the chart, you see that big drop off, and that was COVID. And we were telling our clients our analysts our technical analyst was encouraging us to step into the market when we were extended. And then you can see that obviously the company, or the overall market, recovered. And then late last year, we became somewhat cautious on the market, thinking that it was well above kind of that midline that we see. So while we remain fairly positive on the overall market, we would remain a bit cautious here. And so I think that's why we would, we would potentially see the market falling a little bit more, and just further reason to wanting to be in quality names that can perform well, potentially in a slower growth, higher interest rate, higher inflation environment. We go to the next slide. I'm not sure how many of you follow the market as closely as your financial advisors do, and others presenting here, but I thought we'd include this. Earlier on Monday this week, in the middle of the day, the NASDAQ was down almost 5%. And then buyers started to come in, and the index actually finished up 0.5%. We haven't seen that kind of intraday movement inside the market really since 2008. So, a good 14 years. And there may be people that are managing money that weren't managing money and haven't seen this kind of volatility, but I think it just speaks to making sure that you have an advisor who understands your financial goals and what you're trying to achieve, and that this type of volatility it doesn't shake you out of your equity or your positions at the wrong time. We actually expect that kind of going forward, we're going to see a lot more volatility. We have seen it this week, but we think there's probably it's going to be a little bit more choppier than we're used to. And so again, speaks to having somebody that can put a plan together for you and help you stay the course. Here's another chart that was put together by somebody I follow, and I thought we'd just simply put it up, and just shows that when the market, in this case, we're not talking about the NASDAQ, we're actually talking about the S&P, which would be 500 of some of the greatest companies in the world, companies like Apple and Microsoft and Amazon and Facebook and J&J and Berkshire and Exxon. Some of the greatest companies in the world are inside the S&P 500, do business all over the world, and it's fairly unusual for the S&P to fall 10%, kind of inside of 2 weeks, if you will. And so that is what has happened. And so the natural question is, well, what happens next, or what happens in the next kind of 3 weeks or 6 months? So we have really kind of 6 instances in which the market fell that fast, that quickly, and then we can look back at history as somewhat of our guide in terms of what may happen. And obviously, past performance is no guarantee of what will happen, and there's lots of different reasons why the S&P fell at different instances in history. But what we want to make clear is that you want to stay the course, and the way that you're going to be able to retire or to meet your financial objectives, whatever they might be, is not, again, to get shaken out and to have a longer term view. And you can see here that we sort of expect that in the next kind of 3 months, if history's our guide, that you'd kind of be up 7.5%. The S&P is already up from its bottom. And then, in 6 months, we'd expect it to be higher than that. And then over the next 12 months, even higher. So the idea is to use pullbacks like this to add or to improve the quality of the portfolios that you might have as portfolio managers. We would do that, or simply to, add to positions that you already have, but ensuring that they're high quality. And then this is a relatively kind of a busy slide, and I don't think I'll go through all of the points here. I might just hit on a couple, but we're, as I highlighted earlier, we're the market has pulled back relatively quickly at the speed in which we don't normally see. And what also makes it unusual is that it fell from all-time highs. So typically a market wouldn't fall from all-time highs that quickly, but we call that an oversold condition, which means it usually will bounce. If you think about holding a ball underwater, a toy ball underwater, and the more that you push it down, the more likely it's going to come back. And markets are similar in terms of being oversold. That idea that a lot of pressure on the downside usually means that it will pop. The other thing that we're in the middle of right now is just earnings season, and Microsoft reported last night really strong numbers. They beat estimates. There's many other companies that are reporting again stronger numbers than expected. So this gives analysts and financial advisors confidence in buying more, if you will, in the market, and further supports the valuations in terms of stocks. The other thing that's interesting is soon companies will be allowed to buy back their own stock. So it's called a buyback window. There's certain restrictions on companies that, as they're about to report, they can't buy their stock back until they've reported. So after they report, they're able to enter the market and buy their own stock. So look, there's lots of reasons to be bullish on the market. If we look at the next slide, we're not so naive as to think that there aren't challenges facing the market. And obviously, if the market does sell off, it's not without some reason. I think the biggest topic that's in front of everybody's mind is just inflation. When I was working downtown, I used to go for lunch, and here in Toronto, if you got a sandwich before the pandemic, it used to cost you sort of $9. Now I went down to the same food court, went to the same vendor, and it was kind of $13.50. And I looked, and I was going to say, I didn't order a drink, but there was no drink on there. So I think we're all feeling this element of inflation. Everything's more expensive, and as a result, the Federal Reserve, as well as the Bank of Canada, will increase rates to kind of slow that down and slow the economy down. So interest rates are a headwind, and we should expect that sometimes is a challenge in terms of borrowing. It's going to cost more, but it's not the first rate increase that usually challenges the market. It's the last one. So the reason that the Fed or the Bank of Canada is raising rates, and I should say the Bank of Canada didn't raise rates today, earlier today, but the reason they're increasing rates is because the economy is strong. So that's, I think, an important distinction. But definitely there's going to be some challenges with rising rates. The market's going to need to think about that. And then growth is slowing. We've had just an incredible benefit to all of the money that our governments have pumped into the system to help people who aren't able to go to work. All that stimulus, makes its way into companies, and it's growing in different companies in different ways. But as they pull that stimulus back, obviously we're going to grow at a slower rate. So, to state the obvious, we're still challenges around the Omicron virus and potentially other variants that are coming. I'm speaking to you from my home, as I think everybody else is online is for the most part at home. So that this again presents a challenge. Have we peaked? It's not clear. There's evidence to suggest that the worst is over for this variant, and obviously we're all hopeful that there isn't a worse one or another one to come. But these are things that market participants and companies need to think about and are a challenge to the market. All right, I'm now going to hand it over to Meng Gao, who works closely with me, and he's going to walk through some of the solutions that we provide at Canaccord. Maybe just I'll pause here and just answer this question that somebody has put in the question box really quick. It says, question is, what's the best index to buy for growth in 2022? And the short answer really is that you'd want to buy the NASDAQ 100 or the NASDAQ, which is a technology-laden index. It's pulled back, pretty close to, like I said, 14% in the last month or so. And so that would be probably the index that if you were sort of feeling lucky and you really wanted to chase growth, that would be probably the index that you'd want to go after, and it's pulled back substantially. But we always want to be careful when we recommend things. You need to consider that within your overall financial plan, and obviously there's Jeff and team on the call here can really help you with that. So we want to be careful and cautious around recommending any particular index, if you will. So clear up that question, and we'll go right to Meng to talk about some really high quality products that we offer here at Canaccord. So over to you, Meng.
Yeah, thanks, Kev. Hi, everyone, and my name is Meng Gao, and thanks for giving us the opportunity to present in front of you today. I'm a senior associate on the investments and advisory solutions team here at Canaccord, and I work alongside Kevin Vandermeer, whom you just heard from. And together we do manage a few portfolios that are available for you to get involved in. And obviously, if you're interested after the call, I would get in contact with your lovely investment advisors here. So the first portfolio that I'd introduce you to is our global ETFs portfolio. We'll get to this slide in a minute, but just high level, I mean, it's called the ETFs portfolio because we don't own any single one stock. Instead, there are around 10 ETFs that are the same as if you were buying hundreds or thousands of individual stocks. So the idea is it's obviously much more cost beneficial, efficient, and manageable. And the purpose and really these portfolios are meant for clients that are looking for a truly globally diversified product and using a balanced approach. And what that means is having both an equity as well as a fixed income component to them. We find that clients typically are either super jacked up in their equities or vice versa in fixed income. And very rarely do you find a fine balance between the two. And if you're a Canadian investor, which I assume most of you on the line probably are, you probably have a majority of your portfolio concentrated in Canadian equities. This is not surprising. I mean, if you look at a study done by Vanguard that dates very, very back, the Canadian and Australian investors actually suffer the most from this phenomenon called the home country bias. And what that means is our home equity index actually makes up a mere tiny 3% of the global market index. Yet Canadian and Australian investors will typically find themselves owning anywhere between 60 to 70% of their portfolio in Canada. So if you think about it, this really makes no sense. The only reason for that is because you simply live in Canada. And if you take a step back, it's not like Canadian markets outperform or anything. In fact, if you look at history, it actually tends to sometimes lag versus other regions. So ultimately, why diversify? I mean, if you've been in the market for only the past decade or so, you probably feel like there's no need to diversify, right? Like why would I buy anything else when I can just go to the US and buy a bunch of US stocks? Sorry, the slide disappeared there, Jeff.
Yeah, I just had to reset it. It froze up for a sec.
Okay, so yeah, so why would you buy any U.S. stocks? But it is a case for now. But if you actually look back at history, during the 1970s, during the 1980s, and early parts of 2000s, the U.S. market actually did underperform, believe it or not. So if you had all your eggs in one basket, U.S. equities, you would be watching the rest of the world fly by you while your portfolio lagged. So all this just goes to say that not any one part region continuously outperforms over the other. And instead of guessing, economic growth or economic activity, fiscal monetary policy of any particular region, it's probably best to spread your eggs in multiple baskets, just so you can capitalize on growth of any one particular region. So onto the slide before, Jeff. We have our performance table here, and you can see there's actually 6 names. This is because these portfolios do come in variations, really depending on your risk appetite and your risk bucket. So if you are risk averse, you're looking for something on the safer side, you look at the conservative, which is coming in at 40% equity and 60% fixed income. And if you are looking for something more aggressive, then we have the capital appreciation at 80-20. But typically we find the most popular ends up being the balanced growth, which is 60 equity and 40 fixed income. And no surprise, again, I mean, there's a bunch of literature and academic research that suggests over a long-term period of time, a portfolio of 60-40 actually does tend to outperform. And we have track records of up to over a decade now. And take a look at the second last column to the right here. This is the annualized since inception return. You do see the balance growth actually pulling ahead above the rest, obviously with an exception of the US growth, which is very similar, 65-35 and denominated in USD. And then second column to the left here, 2021, we finished the year off with almost 14%, outperforming the analyzed return by a little over 5%. I obviously wouldn't expect this every year, just given certain microcycles and what's going on in the market. But I think you can expect somewhere around 7 to 9%, which is probably in line with the since inception return. But obviously 2022, we're hoping to continue the stellar performance. On the next slide here is very busy. Maybe you can take a closer look after the call, but essentially 2 things I'd point out here. So where possible, we do try to get the CAD hedge version of all the ETFs that we own, just to simply take the currency out of the equation. And then the second thing is all these variations of the ETFs portfolios essentially hold the same ETFs, but just in different weights, depending on which variation you're looking at. And again, the variations that I mentioned are in the column listed here. So we'll go over each holding or bucket, if you will, so you know exactly what you're owning. You have 6 buckets on the equity side. So you can see you're still getting a very healthy dosage, if you will, of the Canadian equities. And then in global equities is divided evenly between S&P 500 US and then international equities, EFI, which stands for Europe, Australasia, and the Far East. And you know what, 2022 might not be a bad year to start owning some European equities, just given the central bank policy divergence, and obviously with Canadian Central Bank of Canada leading the hawkish tone and the ECB maintaining their dovish stance. So obviously, which could be a tailwind and good for overall growth stocks in that region. And then with an exception of the conservative, all these portfolios also have a exposure to emerging markets as well as US small caps. So for those that don't know, a majority of emerging markets is actually made up of China. And obviously, as Kevin mentioned in the beginning, 2020 would have been a great year to have Chinese exposure, given it actually outperformed the US markets for a period of time, believe it or not. But obviously 2021, it pulled the portfolio a bit lower, just given the economic plateau and obviously a bunch of the crackdowns in key sectors by the Chinese government. And obviously we can't forget the latest and greatest Evergrande debt issue. But 2022, a lot of economists are already starting to say that the next leg higher in the overall equity markets could be pulled forward by a reignition of the Chinese economy. And we're already kind of seeing that, right? I think just over a week or 2 ago, the Chinese government actually lowered a bunch of key benchmark rates. And there was one key rate that has never been lowered since April 2020, which was the heat of the pandemic. So they're trying everything that they can to reignite the economy once again. And then for US small caps, I mean, 2020 after the pandemic was a huge risk on environment. So obviously helped the portfolio a lot, but 2021, it did pull the portfolio down a bit, just given the rise in headline inflation risks, and obviously became sort of a risk off environment. But if it ever became a risk on environment again, you would have meaningful exposure and the portfolio would be pretty torqued up by a small exposure to US small caps. And then the last two buckets on the equity side would be global real estate and then global infrastructure. So real estate was actually the second best performing sector in both Canada and the US in 2021. So obviously this helped the portfolio a lot, and obviously rally on the back of just the emphasis on owning real assets and inflation risks. And then the last bucket, global infrastructure, obviously helped the portfolio as well in 2021, just given the infrastructure bill, the fiscal stimulus, the shift from growth to value, emphasis on owning real assets to generate free cash flow. And then a lot of the holdings actually, a lot of the holdings actually in this ETF are actually some sort of play or derivative to the energy trade. So energy was the best performing sector in 2021 and continues to be actually the only sector in the green year to date. So obviously on the back of the energy oil trade, this ETF or this exposure here helped the portfolio as well. And then on the fixed income side, you have three buckets. So a majority of your weight goes into the Canadian universe bond. So this gets you basically all the bonds in Canada. And then there's a specific tilt towards Canadian corporate bonds, as well as high yield bonds. And high yield bonds would have helped the portfolio a lot in 2021, just given it was actually the only sub-asset class in fixed income that finished the year positive, while the other bonds sort of sold off on the back of expected rise in interest rates. So on the next slide here, apologies once again, it's going to be very busy again, but this is just essentially the 60-40 balance growth blown up, and really wanted to show you how the portfolio is currently stacked against the benchmark. So on the right side of the slide, in the blue column here, the numbers that you see in the boxes are the benchmark weights. And right now there's a box around them because the portfolio is sort of right on benchmark. And this is really because on a semi-annual basis, we will try to rebalance the portfolios back to benchmark just to account for the market drifts. And this would have happened a little over 2 weeks ago. But we are allowed to be underweight each bucket or each group, if you will, by 10% or overweight by 10. So we do these portfolios under consultation and collaboration with all of our strategists here at Canaccord. So, you might know the names of Tony Dwyer, Martin Robert, Javid Mirza, and after consultation, if we do feel strongly towards or feel really bullish towards, say, European equities or international equities, you will potentially see us going overweight there to potentially generate more alpha. And then on the last thing here I'll point out too is on the bottom left table, it's our performance table once again. And as I said, 2021 was a great year, and we finished the year up almost 2% above the benchmark. So that's it for the global ETF portfolios. And then the next portfolio I'll leave you with today is our North American focus equity. So apologies, it's been under 1 year, so there's really no performance available yet, but the history behind its portfolio was actually due to, we started this portfolio off of great demand from the advisory channel here at Canaccord. Kevin and I, we do manage a standalone Canadian and US focused equity portfolio on its own. And, after 3+ years of solid performance, great user feedback, we were asked to put our best ideas together to form this North American portfolio. The benchmark is 50% S&P, 50% TSX, so half and half split evenly with Canada and the US. And you'll typically find anywhere between 25 to 30+ holdings. So in general, it's for clients that are looking for a true North American equity exposure to blue chip, large cap, high quality stocks. And we do try to rebalance this on a monthly basis. So just very quickly, a little bit about our process and discipline. So we like to use a multi-style factored approach, and we're actually very systematic in everything we do. And that tends to remove the emotions and bias out of the equation, which is actually an Achilles heel for even the most prominent investors in the world. But to make it simple, I like to think of our process as a 3-pillar process. So the first pillar, you have your fundamentals, and then second, you have your quants, and the third is technicals. So we've back tested a bunch of factors over the 2+ decades, and we determined there's actually 3 factors that have consistently generated alpha and outperformance. So the first one is free cash flow yield. Now this is such a great factor, and it takes up the fundamental pillar, because it, in a way incorporates all 3 of the financial statements. So you have your income statement, balance sheet, as well as your cash flow statement, obviously. And then it really shows you the financial health and stability of a company. And in other words, its ability to pay off its obligations. And then the second factor that we like is low volatility. So low volatility strategy simply means buying stocks that have a lower volatility or lower beta. And for those that don't know, volatility, in other words, means lower dispersion of price, lower variability of price, or in other words, lower sensitivity of a price to the market. And then the last factor that we like is the momentum factor. So this factor, what it really means is buying stocks that have done well and will ideally continue to do well. So each of these factors have, on a standalone basis, have outperformed the market over the long run. But the beauty behind connecting all 3 of these and putting it together is that not any one factor continuously works in all parts of a market cycle. So momentum, for example, really lacks power in a market turn or market corner. So this is where ideally the low volatility piece would kick in, and together they form a very robust strategy that has done very well for us. But where the quant piece comes in is, we've once again done a lot of research, back tests, and we've assigned very methodical weights to each factor. And ultimately, each factor's weight comes together to form a final score or final rank that we put beside each stock in the benchmark. And ultimately, only the highest ranked stocks, or say, the top 40 ranked stocks, gets picked into our portfolio. We don't ever force any rebalances, so there's no score deterioration of the stocks currently in the portfolio, and there's nothing scored higher, then we'll simply leave the portfolio as is. So as you can see, it's a very systematic process, and this we found has really worked well for us. So the next slide, the last slide for today, it shows you exactly what we own currently in this portfolio. I forgot to mention, so the beauty behind the North American portfolio is that, in Canada, it's a very resource-focused market. So, you have your plethora of energy stocks, materials, and financial stocks, but you really lack prowess in sectors such as healthcare and technology. So this is where being able to go to the US and grab some of the, best high-quality blue chip companies allows you to sort of combine the two and get the best of both worlds. And then on this slide here, you can see we have exposure to every sector essentially. And really this shows that, Kevin and I, we don't like to make any big sector bets. Instead, we sort of like to pick the best company in each sector, and that's how we sort of generate our alpha. Once again, this portfolio also utilizes the ETFs approach where applicable and appropriate. So on the bottom right corner here, we have a large weight towards the FANGMA ETF, which stands for Facebook, Apple, Netflix, Google, Microsoft, and Amazon. And then on the Canadian side, we have the XIT, which gets us exposure to Shopify and Constellation Software. So really the benefit of this is for some of our friends or clients with smaller accounts, you don't run into any of the high ticker issues, like trying to buy Amazon and getting half allocations, which don't exist because Amazon refuses to do a stock split and it's trading at 3,000. So there's a true benefit to that. But we'll run through sort of some of the stocks here, so you really get to see the characteristics of the portfolio here. So on the top left, you have your energy sector, and you see we currently own Enbridge and ExxonMobil, obviously the largest energy companies in Canada and the US. And then in materials, you have a wide variety of exposure. So you have some gold exposure via Franco-Nevada, basic materials, fertilizers with Nutrien, and then you have a US painting company, Sherwin-Williams, which obviously capitalizes on the back of the home DIY growth that stemmed from the pandemic and has continued ever since. And then in industrials, you have exposure to the second largest rail company in Canada, Canadian Pacific Railway, and then a waste management company, Waste Connections. And then if you jump down a few sectors in healthcare, as I mentioned, there's really not much choices you can choose from in Canada. I mean, unless you want to own a bunch of underperforming cannabis stocks, but this is where you can go to the US and grab some names like Johnson & Johnson and United Health Group, healthcare insurance company, and really stack up and beef up the portfolio. And then the last thing I'll touch on is just the financials, right? So once again, you have your meaningful exposure still to Royal Bank, TD, Brookfield Asset Management, and then on the US side, JP Morgan and Berkshire Hathaway. So I'll leave it there today. Hopefully you were able to learn a thing or two about these two portfolios. And once again, if you have any interest, please reach out to your investment advisor team.
All right. I see there's a question in the chat box. The question is, do you expect emerging market index to outperform most North American indexes? And that's actually a very good question. I think the way to think about it is to have a framework around commodities. So emerging markets, and to some degree, the Canadian market is highly leveraged to commodity prices. So in Canada, we're leveraged to oil, obviously. In places like Australia, they'd be more leveraged to base metals. And typically, the emerging markets would benefit from higher commodity prices. So, to the extent that you think commodity prices will be elevated, or there's a shift in a higher inflation environment to more commodity-related investments, that would be a benefit to emerging markets. Let me just say that with a couple of caveats, and that is, emerging markets traditionally are dependent upon China. So a lot of what is sold in emerging markets, and I'm thinking of sort of Pan-Asia at this point, is sold into China. So, and China sends a lot of product to the US. So nothing is sort of an island onto its own, if you will. So to the extent that the US economy is strong, there will be more imports from China, which means the emerging markets do better. The other thing is that, obviously we're all sitting in the West, and we are the beneficiaries of Western medicine. Some of the emerging markets, to be quite frank, haven't been as fortunate. And so, the Omicron variant is a challenge in a different way to those economies than it is for us here in North America, and has impacted their supply chains in different ways. So, hopefully I've answered your question with some, caveats and some ways to think about that investment. I'll maybe hand it over.
Kevin, Raheem here. I have we get a lot of feedback from clients and a lot of questions. And investing is just a real mark of patience. The last time rates were raised was such a long time ago in 2018. In most people's perception, especially with media, the world was coming to an end, and it didn't. And with interest rates now moving, in a positive direction, because it'll rebalance asset classes and it'll start to drive the quality equation of investing, which I believe for the part of 2021, it was really a risk-on mandate across various sectors like crypto and just looking at things in terms of the meme sort of investing, where people felt like they weren't participating enough in risk, and risk can slap you in the face if you can't control it. So moving on to 2022 now, pandemic has become something that's part of culture now, and it's part of the investment equation. But there's no real substitution for quality, because some of the best companies in the world have the resources to continue to grow, especially with technology underpinning most asset classes, including energy. Thoughts now moving forward, a lot of, especially Western Canadian clients of ours, really want to try and understand energy and where it goes here. Do you, in your perception, is this a momentum trade for inflation, or is there a real supply-demand disconnect moving forward as more of the Western economies start to gain a footing, travel and leisure starts to pick up, and just some comments around that? It's real topical right now, and people, want to hear what your sort of viewpoints would be there.
Sure. So I can provide some comments, and Ming can add to them. So first of all, there's individuals that are far more informed about oil than I am, and probably some of them are on this call. So let me just say that as an opening. I would consider myself a generalist in terms of, and then I look at all sectors across Canada and the U.S. And we do invest in energy. So from a big picture point of view, I think it would be no surprise to anybody on this call that there's been significant underinvestment in energy, and it's been, not just last year. It's been, probably a decade of underinvestment. So what does that mean? It means that new reserves haven't been found, existing reserves haven't been developed, and so when you put that all together, you have supply constraints or challenges, and that is in the face of economies that continue to perform well. Economies are growing, especially in sort of less developed parts of the world. They're still highly reliant on energy, and in particular oil, and that doesn't appear to be slowing down. So you kind of have this, what I would call like a squeeze trade, where you've underinvested, and so supply is hard, but demand has continued. And so I think in my mind, it's sort of less about inflation, and kind of, inflation's probably a 1 to 2 year event. I could see energy is much more of a sort of a shift, a fundamental shift, because of the underinvestment. And when you talk to people in the sector, that becomes quite apparent. So that's sort of, I would say, on the fundamental side. The other part that I think people are, there's sort of this concern, a new concern that's come into the market, I'd say in the last 3 months, and that is what Russia's doing in Ukraine. It's no secret that Russia is highly dependent on gas for a lot of its revenue and how it funds the country. And so what's interesting about Russia is every time oil gets kind of above $70 or $75, they get kind of frisky, because they all have a lot more cash slocking around. They usually try to go invade somebody, so which only helps the price to go higher. So people like Goldman Sachs, would say that oil could actually go to 120 if Russia does invade. Now there's varying views on that, and how they would approach it and what they would do. And it seems like the tension there has dissipated a little bit, but it's not like they've removed their troops. So that's another element being kind of introduced, and there's always sort of geopolitical risk that's happening around the world. But we as sort of financial analysts, if you will, would look more at that supply demand constraint. Like, I know we all drove a little bit less, during COVID, but, we spent money on other stuff, like, hot tubs and boats and all kinds of stuff, and all that stuff, gets built with derivatives of oil and we painted our houses and bought new furniture and all kinds of stuff. So all of that stuff uses oil as well. So did we use actually less oil? Maybe, maybe not. I don't know, Meng, did you want to add to those comments at all?
No, I no, I sort of missed the initial question there, but no, the only thing I would add to the your energy comments, Kev, would just be, when we speak with some of our analysts that talk to these management teams, all day, one of the key things that we keep noting is resurfacing is just that, unlike the previous cycle where oil prices rallied, all these upstream producers were putting a lot of money into the ground just to get additional supply. But this time around, they're really reluctant to do that. And instead, so that's going to persist with the supply issue. So demand will ideally be greater than supply. And I think these companies are more focused on giving back to the shareholders now in the form of dividends. So
that's great. That's great. Those are great comments. And I think it provides perspective that, as we start to, and investing is all about sectors and rotations and the movement of capital and the velocity of capital. But for the everyday investor, when they start to see the captions in the media and they see the gyrations in the market is just realizing, what's the expected growth rate now with these new variables. And I think a lot of our clients are very, we try to provide as much commentary and as much guidance as we can. We always want to make sure that, they understand that investing is so much of a process. It's the strategies that are going to help that process succeed. But I do have one question, and then there's a question in the box. Any sort of comments on Canadian housing? It's becoming very topical again, just like energy. It's a very hot sector. You got a real undercourse of lack of, I think and it probably mimics energy, just underinvestment or inability to expand major centers like Toronto and Vancouver. Where does the tipping point, from your experience, come in here in terms of where Canadian housing goes in relation to maybe supply and investment per se, or just comments on that from what you've read?
Yeah, it's certainly, and again, I wouldn't consider myself an expert in housing, but it is a real challenge. And I think, the fact that so much money went in and there was easy money to be had, unfortunately, there's unintended consequences. You're helping people who are home that have restaurants and people that are running businesses that legitimately can't function, and they have families, they need to provide for their families, or they need to take care of a sick person, someone who's not well in the midst of COVID. But it also has, unintended consequences. And I think one of the biggest unintended consequences that we've seen is, Canadian housing, and it's outstripped, a lot of people who are, the average worker now needs support from a family member or from a parent with a down payment. And it's a complex issue, and I'm not exactly sure how to resolve it. I mean, I'm sitting here in the middle of Toronto. There was a real, movement there for a while to move kind of out of the city, and there was a lot of homes that were built, kind of outside the city, and that supply came on. But then, people realized that they were commuting for an hour and a half a day, and that time they just don't get back. So they were willing to move into the city, into something smaller that would, enable them to spend more time with their families and their kids. And as a result, prices in the, kind of call it the core of Toronto, and I've sort of a, sample size of one, if you will, those homes have gone up. So yeah, I'm not sure what the answer is. And I was meeting with a friend of mine, a very good friend of mine, and he was actually talking about just the challenges that Canada has if we don't open up and allow greater immigration in the country. You know, that in 10 years or 15 years, we're going to have different problems if we don't have more people come into the country. So, you know, while you think about how do we attract more immigrants to the country, it would almost seem like it would exasperate the housing problem, as many of these people, you know, tend to come to urban areas rather than rural areas. So, yeah, I don't have a really informed view, other than I fully recognize that it's a real challenge as we, you know, burden young people with you know, sizable debt, and you know, you can restrict foreign investment, you can stop people from buying certain things if they don't live here, but those all feel like things around the edges, and not really, you know, addressing the fundamental core issue, which is affordable housing in Canada, which is an issue.
Yeah, that's probably the root of the issue is the lack of supply to absorb some of the pressure in that sector, which again alludes to the simple components of investing, and those are for certain groups opportunities in on the real estate side of things. Jeff, that's it for me. I'll leave it to you to conclude.
Well, thanks very much for all you sharing your lunchtime with us. A few more questions that have come in that I'll reach out to you afterwards, and we can talk a way through it. Feel free to reach out to Raheem, Dave, myself, and talk about the solutions themselves. Meng, Kevin, really appreciate your time, and especially the support that you provide that the clients don't see. That is instrumental to our day-to-day. It really helps us do our job better, so we can focus more on the clients. So thank you for sharing your time as well with us. And with that, I'll wish everyone a good afternoon, and we'll chat soon.
All right.
Thank you very
Bye for
much,
now.
Kevin.
Thank you.
Bye for
Bye
now.
now.